Being a chartered accountant, I have been getting a lot of questions on investments. Now, today I will be talking at length on the investments and what could be the best investment policy. The first thing that I would like to mention is that there is no fixed policy, one policy for everyone. It will depend on each profile of the person. If you are a young professional starting your career, then your risk appetite will be much higher than a person who has retired from work. But let us first see what is the main objective of investment for any person: to have their wealth grow. Now, to achieve this policy, it is very important to find out what is the inflation index of the country in which the investment is being made. I presume that all investments are being made in India, and the inflation rate that is currently prevalent in the Indian market is something in the region of 6 to 7% on an average basis. Now, let us try to understand what is this inflation index or average inflation index. It talks about the price rise in every commodity as we go along the years. Therefore, if 100 rupee could have bought a certain amount of items, the next year if there is an inflation index of 7%, then it would be able to fetch lesser quantity than it was in the previous year. Therefore, every investment should target to at least overcome the inflation. Otherwise, your wealth remains at the same level as it was in the previous year, or maybe even lower. Well, the interest that is earned in banks across India is something in the region of 6.5% for the general category of citizens, and for senior citizens is 0.5% higher. So it is almost close to the inflation index. Therefore, a bank investment or investment in fixed deposits in banks will yield you as much interest as will just about beat the inflation. But there is no growth. So while a portion of your investment could be fixed deposits of banks, but a major part, or depending upon your risk appetite, should be invested in investments which will yield you higher than the inflation returns. What are the options available to you? The options are very less. One could be the bonds and debentures which are issued by certain companies. These provides interest rates which are higher. But then also you will have to see whether the taxation is taken care of, because after tax, if your return is lower than the inflation index, then also you land up in a situation where your wealth is lower than the previous years. An option which is also getting great momentum in our country is the mutual funds. And mutual fund investments could give you a return which is much higher than the return that you earn from fixed deposits. There are several types of mutual funds, but the two important ones are the debt mutual fund, the equity mutual fund, and the balance funds. Debt funds have lower rates of returns and is more secured. Equity funds have higher returns but is less secured. A mixture of the debt fund, equity fund, or the balance fund should be what your portfolio should consist of. For those of you who are having a lot of risk appetite, particularly for young people who are at the beginning of their career, they can afford to even go to the secondary market and try investments in equity shares directly. This could earn them quite a bit of return and could be higher than the normal return that you get from mutual funds also. However, the risk is that when the market goes down, there will be a huge fall in your investments. Therefore, my suggestions would be that you spread your investments across various types of investment that is available in the market. You should also think of investments in mutual funds, but go for those companies which have a steady return rather than a fluctuating return. You must also be careful that the net asset value is not going down lower than the previous year's rate in order to give you the interest from your mutual funds. Basic precautions and go for investment which will beat the inflation. These are my take, my view on investments. Thank you.